You've been doing everything right, or at least that's what it feels like. You've got a stable job, maybe a partner who also works. You've been saving, not perfectly, but consistently. And somewhere in the back of your mind, there's this quiet voice that says, I think we're ready. I think we can buy a house. So you start looking. You open Zillow on a Tuesday night. You scroll past a few places, and then you see it. A 3-bedroom, decent neighborhood, a little yard. It's listed at $500,000. And your first thought isn't fear. It's excitement. $500,000? That's doable, right? Here's the thing. I'm not going to tell you it's impossible, but I am going to walk you through the real numbers, the ones nobody shows you on the listing page, the ones your lender probably won't emphasize, and the ones that quietly determine whether you'll feel like a homeowner or a hostage. Because there is a massive difference between getting approved for a home and actually being able to afford one. We've been taught to think about home affordability in a dangerously simple way. You hear things like, your mortgage should be about a third of your income, or if the bank approves you, you're good. And that framing, that shorthand, has led millions of people into homes they technically own, but emotionally can't breathe inside of. The bank doesn't care if you want to take a vacation. The bank doesn't care if your car needs new tires in March. The bank doesn't factor in that your kid needs braces, or that groceries now cost 30% more than they did 3 years ago. The bank looks at your income, your debt, your credit score, and it gives you a number. That number is the maximum it's willing to risk on you, not the amount that lets you live well, the amount that keeps the bank safe. And that distinction matters more than almost anything else in this conversation. So, let's actually do the math. Not the fantasy version, but the version that tells you what your life looks like on the other side of that closing day. Let's start with the sticker price, $500,000. That sounds like one number, but it's actually the beginning of about 7 different expenses, most of which are invisible until you're already committed. First, the down payment. If you're putting down the traditional 20%, that's $100,000 cash before you even get the keys. Now, a lot of people don't have $100,000 sitting around, so let's say you put down 10%, $50,000. That's still a significant amount of money, but it also means you're borrowing $450,000 instead of $400,000. And that difference isn't small. It follows you for 30 years. Now, let's talk about the mortgage itself. As of where rates are trending heading into 2026, let's use a reasonable estimate, somewhere around 6.5%. That's not a scare number. That's roughly what the market is projecting, give or take. On a $400,000 loan at 6.5% over 30 years, your monthly principal and interest payment comes out to about $2,528. If you only put 10% down and you're borrowing $450,000, that jumps to roughly $2,844 a month, just a loan, just the basic cost of borrowing. But the loan payment is only the beginning, and this is where it gets uncomfortable. Property taxes on a $500,000 home vary depending on where you live, but a reasonable national average puts you somewhere around $5,000 to $6,500 a year. That's another $420 to $540 per month. Homeowners insurance? That's been climbing sharply, especially in states prone to storms, flooding, or wildfire risk. You're looking at roughly $150 to $250 a month, depending on your location and coverage. And then there's the one nobody wants to think about, maintenance. The general rule is that you should expect to spend about 1 to 2% of your home's value every year on upkeep. On a $500,000 home, that's $5,000 to $10,000 a year. That's the furnace that dies in January, the roof leak you discover in April, the plumbing issue that doesn't care about your budget. Averaged out, you're adding another $400 to $800 a month in real ongoing costs. Oh, and if you put less than 20% down, you're likely paying private mortgage insurance, or PMI. That typically runs between $200 and $350 a month, depending on your credit and loan terms. It doesn't go toward your equity, it doesn't build you anything, it's the cost of not having enough cash up front. So let's add it all up. On the conservative side, 20% down, modest taxes, average insurance, reasonable maintenance, you're looking at roughly $3,500 a month in total housing costs. If you put 10% down, you're pushing past $4,000. In some markets, it crosses versus $4,500 with ease. Now, here's the question that matters. What kind of income do you need to carry that comfortably? The most commonly cited guideline is the 28-36 rule. Your housing costs shouldn't exceed 28% of your gross monthly income. Using that framework, a $3,500 per month housing cost means you need a gross household income of about $150,000 a year. At $4,200 a month, you're looking at $180,000. The median household income in the United States right now is somewhere around $80,000. Let that sit for a second. The math isn't just tight. For most households, it's not even close. And here's what makes it worse. Those income numbers are gross, meaning before taxes, before health insurance premiums, before retirement contributions, before all the other deductions that shrink your actual paycheck. Your take-home might be 65 to 70% of your gross. So if you're earning $150,000 a year as a household, you might be bringing home around $8,500 a month. And if $3,500 of that goes to housing, you're left with roughly $5,000 for everything else: food, transportation, childcare, subscriptions, student loans. Life. Is it survivable? Sure, for some people, but is it comfortable? That depends on what you mean by comfortable, and that's where psychology.
There's a term in behavioral economics called the house poor trap. It describes people who technically own their home, but have so little financial flexibility left over that they can't save, can't invest, can't absorb a surprise, and can't enjoy the life they assumed home ownership would give them. And the cruelest part of this trap is that it often doesn't feel like a trap at first. You close on the house, you post the photo with the keys, everyone congratulates you. For a few weeks, maybe a few months, it feels like progress, like arrival. But then the weight starts to settle. You realize you haven't added anything to savings in 3 months. You start putting off dental work. You hesitate before buying groceries that aren't on sale. And slowly, quietly, the house that was supposed to represent your freedom starts to feel like the thing taking it away. This isn't about being dramatic. This is what the data actually shows. Studies have consistently found that financial stress is one of the leading causes of anxiety, relationship conflict, and even physical health decline. And the number one source of financial stress for homeowners isn't the mortgage itself. It's the gap between what they expected life to feel like and what it actually feels like once the real costs set in. So here's the mindset shift I want to offer. And it's a simple one, but it matters. Affording a home doesn't mean being able to make the payment. It means being able to make the payment and still live a life that doesn't make you miserable. That's the line. And it's a line most people don't draw until it's too late. So what does this actually look like in practice? How do you figure out where you honestly stand? Start by calculating your real monthly take-home pay. Not your salary, not your gross, the actual number that hits your bank account after everything is deducted. Then take 25% of that number, not 28, not 33, 25. That's your honest housing budget, the version that leaves room for the rest of your life. If 25% of your take-home doesn't cover the full cost of a $500,000 home, mortgage, taxes, insurance, maintenance, maybe PMI, then that's not your price range right now. And that's not a failure. That's just information. Next, look at your savings honestly. Not just the down payment, but what's left after the down payment. Because if you drain your entire savings to hit 20% down, you're walking into home ownership with no safety net. One emergency, a layoff, a medical bill, a major car repair, and you're in trouble. A good benchmark is to have at least 3 to 6 months of total expenses saved beyond your down payment before you buy. And finally, this one's uncomfortable but important. Examine why you want to buy right now. Is it because you've done the math and it genuinely makes sense for your life? Or is it because you feel behind? Because your friends are buying? Because your parents keep asking? Because social media makes renting feel like failure? Those pressures are real. I'm not dismissing them, but they're not financial plans. They're emotional currents. And making a $500,000 decision based on an emotional current is one of the most expensive things a person can do. There is nothing wrong with waiting. There is nothing wrong with renting while you build a stronger position. There is nothing wrong with buying a less expensive home that gives you breathing room instead of a more impressive one that takes your air away. The people who build real, lasting wealth aren't the ones who bought the biggest house the earliest. They're the ones who made the decision that matched their actual life, not the life they were performing for everyone else. I know this video might not feel great. I know you might have come here hoping the math would work out, hoping I'd say, yeah, 500K is totally fine on your income. And maybe it is. For some of you, the numbers do add up. If that's you, that's genuinely wonderful. Go find that home. But for a lot of people watching this, the honest answer is not yet. And I want you to hear something clearly. Not yet is not never. It's just not yet. The housing market will shift, your income can grow, your savings will build if you stay intentional. And when the time is right, when the numbers actually make sense and the decision doesn't require you to hold your breath for 30 years, it'll feel different. It won't feel like a gamble. It'll feel like a grounded, confident step forward. You don't have to rush this. You don't have to prove anything to anyone with a set of house keys. The smartest financial move you might ever make is the one where you looked at the math, respected what it told you, and chose to wait until the timing was truly right. That's not weakness. That's the kind of clarity most people never reach. You're closer than you think. Just don't let impatience be the thing that costs you the most.